chums, welcome back. Welcome back to Economica. Very happy to be with you today. So previously, in my previous videos, I explained why I was so upset and bewildered about the symmetry of inflation targeting for monetary policy and the asymmetry at the same time, large shocks in inflation, volatility, and the asymmetry of shocks, and why the ECB still continues to have a symmetrical target of 2%, or the Federal Reserve has a symmetrical target of near plus or minus 2%. So if inflation is an heteroscedastic volatile parameter. So back previously in my life, in my other video, I was ranting about this stuff. So back to me now, and I hope you enjoyed my video, and please like the video, subscribe if you're new around here. I will tell you a lot of interesting things, all my findings and research, and all my blubbering about macroeconomics, econometrics, and everything about economics, because oikonomika, it's a Greek word that means the idea comes from ta politica, which is the masterpiece of Aristotle about politics, but there are other the same Aristotle wrote a book about economics, which is less known, and many other Greek philosophers, if I'm not wrong, somebody Xenofonte, okay, I'm saying in Italian because I can't translate in English. He also wrote a book about economics. So the idea of oikonomika is ta oikonomika, all about economics, or all about finances. And why? Why I decided to call the channel Oikonomika? Because I'm a strong advocate of the fact that societies, they are made of economic choices. They are not made of political choices. So I'm not saying that human beings, there is always a trade-off between things, but basically to wrap up, the concept is that the word economica comes from oikos. Now, oikos in Greek, it's translated in ancient Greek, it's the word for family. So oikonomika, very basically, because I don't speak Greek, I just know a few words from reading philosophy. So the word of economica comes from oikos. That means the management or the dealing of the domestic economy. Okay, so what this means is that societies, wider societies, the politei, I mean the citizenship, and the polis, or the town, it's made of oikos, or of many small groups which are families. Okay, and so the oikos, the managing of the oikos, from the managing of the oikos comes the word oikonomia, like economics. Okay, so it's the managing of the domestic economy, because in ancient Greek we know that there was the every family home had its backyard, and there was I don't know, there was somebody who was building swords or shields, or there were the families who had land for agriculture, or families, Greek families who had cattle or sheep. So in ancient times, the economy was not a developed market economy as we have now. It was a small domestic economy, and the management of the economy was based on what were the resources of the domestic production. So that's why I decided to call my channel in a very very broad and in a broad line explanation, but I will do a video explaining about economics. Why I decided to call my channel Oikonomika, or Ta Oikonomika, everything about economics, because oikonomia, it's a word that derives from oikos. Oikos means family. So oikonomia is the managing of the domestic economy. And so because societies are made of the basic stone or brick of societies, it's families. Now we can say families are made by a man, a woman, and kids, and grandfather and grandmother and uncle, auntie, whatever. Yeah, and so this is the traditional families, but we can have some other sort of families. I don't want to enter in sociology, but whenever you have let's say not an association of people, but a familiar group of people, then this familiar group of people is linked together by sociological and anthropological reasons and by economic reasons. Okay, so if you take share houses in England, you can have different people that come from any parts of the world, they share a house and they become like a family sort of, and they are linked by economic reasons because they have to pay rent, bills, and so forth and so on. So we have traditional family. There are some other kind of arrangements like couples which are not married but they live together. So, or we can have families where kids live with their grandparents. They don't have their genitors. Yeah, they don't have their parents, or their parents they are divorced. There are all sorts of anthropological and sociological flavors and differences, but the basic stone of society is that group of people that is called family, your family, your relatives. And so the family, the households needs management. You have to pay the mortgage, you have to pay rent, you have to pay the bills, you have to pay food. That is oikonomia. And so when we look in aggregate what is the economy of a whole society, then we call of the domestic economy of domestic gross product, which is or gross domestic product, sorry, which is GDP, the aggregate economic output of a whole country, whole society. Yeah? Just don't misunderstand the word society. This is not an exclusive, like the aggregate output, the whole population in a certain geographical area. It can be the United States, Canada, Mexico, all these basically places which are divided by boundaries, okay, by borders. But I don't know, anywhere, Italy, you know, all the aggregate output, domestic output of Italy, it's the gross domestic product, but still gross domestic product. So GDP still has, even if it's in English, it still has this intrinsic word which is domestic, which identifies with that country, with that geographical area. But that comes from oikonomia, because we have in English we have the word economics that comes from Greek, which is oikonomia. And I just say that oikonomia derives from oikos. Oikos in Greek means family. So it's the management of the economy of the household. Okay, and so the domestic economy. So from the basic group, the basic stepping stone, the basic brick of the fabric of society, which is a family in all its different flavors and anthropological and sociological nuances and heterogeneities. So on a broader scale, which is the whole population, we have the domestic economy of a country defined by border, and that is the gross domestic product. So that's why I called, back in my previous life, I decided to call my channel Oikonomica, Ta Oikonomica, because I don't believe in politics. I believe I've come to the reasoning that politics, it's a waste of time, and it's a place where people, they are brainwashed, they are subserved, they become servient and subservient to ideologies, and politics works for ideas or ideals. But in reality, any family needs to pay the bills, pay the rent, go to work, have food on the table, feed your kids, give an education, and have a house, or I don't know, have some leisure time, go to the library, go to the fair events, like all these I don't know, like The other day was the St. Patrick's celebrations and all these open spaces where there are celebrations with your family and have fun. So people they live for concrete things. They go to the shop, they buy groceries, and that is an economical choice. Not because there is a trade-off, but because society is structured about on economical choices. Okay, everything it's not so simple to say, oh, is the economy stupid? No, because the economy is very stupid. That's the problem. The other side of the coin is that the economic system that we have is very, very stupid, because it's based on consumption, it's based on immediate gratification, it's based on superfluous thing, excess consumptions, excess luxury, all that it's a detriment for the well-being and the development of the person and of society, okay, or the neighborhood, or the citizenry of a town. Because our economy, the economic system that has been imposed on a global scale is an individualistic, selfish economic system, which is based on immediate gratification and on excesses, on excess consumption, which is unhealthy, excess luxury based on ignorance. And that's why then we have all these bad derivation that people, they become xenophobes, they hate foreign people, they hate poor people. You know, it's dehumanizing stupid economy ideology, exactly because it's an ideology. That's why it's bad. So I try to explain you why I call my channel O Economica, all about economics, because life is, the families and societies and whole economies, they're made of economic choices. And so the best point of an economic choice is when basically nobody is worse off, okay, or there is general equilibria, so that like a wave that lifts all boats. It doesn't mean that everybody is rich. That means that society lives on many things which are concrete things, and so are economic choices. That can be a book that you want to read, a concert, and a football match that you want to see, or I don't know, a restaurant, or the job that you want to achieve, and the present that you want to buy to your brother, to your sister, to your auntie, to your to your grandma. All these very nice things. These are all economic choices. But these economic choices, they are intertwined with sociological and anthropological structures, which are, this is a very difficult subject which I'm not an expert of, but the sociological and anthropological nuances and structure of societies, they are a factor, often a determinant factor of economic choices on a broader scale, in a broader population, which is the cities, the whole a town or a region, economic region, or a countries. So, but the thing is that society lives in conflict, in economic conflict. Modern developed society, they live today in economic conflict with the economic regime, because the economic regime, as I said, is an economic regime that is based on individualism, is based on selfishness, is based on instant gratification. So there is no community spirit, there is no looking for the well-being of other people. There is no concept that going to work is trying to achieve progress for the whole of society and for the whole of humanity. Going to work is a career, it's aspiring to a huge salary, huge bonuses, and it doesn't matter if you are dumping in the market CLOs or toxic credit derivatives. It doesn't matter if you are dumping on the financial markets mortgage-backed securities, commercial mortgage-backed securities. It doesn't matter if you are defrauding investors, or if you are defrauding savers, if you are stuffing pension funds, private pension funds, with toxic derivatives which will blow up billions of savings of people. So this is the kind of conflict that we have in our societies, and which is the economic system which is predatory and is selfish, and which is at the polar opposite, and it's in conflict with the well-being of the wider population. That's why we have cost of living crisis. There is struggling of low-income people, the people who have it's defined as at all the echelon of society. We have struggling also for middle-income families, like a family with the mother and father. They have 2 incomes and they have kids. They are struggling. They struggle to afford a house, even if it's renting, or buying for the first time a house for their kids, because there is this selfish concept that the economy it's not made, this economic regime is not made for the well-being of whole, for an average general equilibria that brings a well-being of a whole population, which is the economic well-being. It's also the health well-being, the societal well-being, the diminishing or the healing of societal conflicts, the healing of crime, the healing of poverty. Because the Greeks, they have a lot to teach us. The economic science in ancient Greek was in the same category as the health science, as medicine. The Greeks paradoxically believed that good management of the households was very important for the health, the well-being of the person. Okay, so that's why they put on the same level the economics science with the health science. In fact, we say health is wealth. Yeah, you must be healthy in order to work and to achieve and to be with your loved ones. So that's why, to have a broader economic framework that works for everyone, it includes all parts of society, all parts of the population, without discriminating, but working all together for the well-being of everybody without being subservient to powerful people. It's what the meaning of my channel is. It's Economica. It's all about economics, how society can work well together in harmony for the well-being of everyone, so that there are no societal conflicts. So this is the first stepping stone that we should be able to achieve. At least it's been like 5,000 years that human beings on this planet, maybe longer, but we still have a lot of difficulty because we have to compete, or there are parts of society which repress other parts of society, and there are all sorts of economic problems. Why wages are too low because maybe most of the quantitative easing has flooded financial assets, so people have lived with what is perceived austerity, but now we have exploding public debt to GDP ratio. But where all the money has gone into financial assets, and people, ordinary working people, the 99.9% of society and of the population, they are stuck with the same wages, more or less, that were 10, 20, 30 years ago. It depends from the geographic area that you move around on the geodesic sphere. It's a sphere which is a bit squashed at the poles, which is planet Earth. Depending on the geographic area when you find yourself, you see that financial assets have inflated and locked in their prices, their value, but the vast part of the population in a country, or the global population, they live with the minimum or the average, like middle class, if we want to talk about classes, but I don't believe in the class system. So that's why my aim is to identify what are the imbalances in the economy, what are the problems, what are the financial risks, so that to make ordinary people aware, because at the end the bill comes to the ordinary people, which have to work and pay taxes and eventually the government has to bail out banks or private institutions, which they basically bankrupt the entire global economy. And this is a risk. It's a constant risk that we have all the time. So after I explained back to me now, after having explained why I call my channel Economica, and please subscribe, you have been on this page, which is a Python page, and I've done a little bit of research, and I managed to build my own Taylor rule. Okay, so what is the Taylor rule? So the Taylor rule is the formula that was created by the economist, Taylor, the economist, and which sets the theoretical framework for establishing what is the optimal level of interest rate according to the inflation gap and the output gap that you can find in an economy. Then we have some more modern concept, which is the Loebach-Williams model, which the Federal Reserve still is trying to understand now, which is based on the neutral level of interest rate. But as I will explain in a bit, I don't believe that I don't find the neutral level of interest rate to be just one parameter, and I don't identify the neutral level of interest rate as it has been theoretically theorized. As the difference, it's only the difference of inflation output or GDP output. I strongly believe that to determine the level of interest rate, we need to account for the level of volatility, whether it's the gross domestic product, the variability of the gross domestic product, or the variance, the variability of inflation. And well, the Loebach-Williams model basically utilizes some new Keynesian dynamic, stochastic, general equilibrium framework. So they twist around a bit the economic, the mathematical formula, but it's mostly based on what is the level of output, what is the level of potential output. It depends, but then the big unknown is there are different methods to arrive or to calculate the potential output. So there can be already some discrepancies or different values, and that from a precision standpoint of having a theoretical model for interest rate, when you have a set of different methods to achieve the same result, which is potential output, then you start to wonder which is the number that I have to use. If I use a Odrick-Prescott filter, if I use I don't know, the aggregate supply method, if I have some other method of the other theoretical framework to calculate potential output, which is more or less difficult, if I use an exponential smoothed trend to see what is the potential output in the future. There are many mathematical instruments that can achieve a theoretical result, which I can call potential output. But then to have a sure and a stable and not stable, a solid underpinning model that tells me, okay, this is potential output, that's how I calculate it, I don't want to deviate from that because that's the best estimate that I can have, then, I mean, me personally, I still am not there because I need to study a lot more. But I don't believe that in the central bank academic sphere, there is this precise certainty, okay, on what is potential output. It can be calculated in many different ways. As well as GDP, I can calculate it as the aggregate of the goods and services. I can calculate the GDP just only by seeing, not only, I can compare the aggregate supply or production in the economy of all goods and services, and I can compare it with that of the previous year. So I can see the change in GDP by the stock and the aggregate production of goods and services from quarter to quarter or year to year. So a country can be it could be growing its aggregate supply if it's producing more goods and services. Then I can calculate GDP on the base of consumption. If I'm consuming more goods and services, like what is GDP price index, GDP on the basis of sales, aggregate sales, and I can calculate GDP also on adding some other variables. What is the stock of savings? There are many nuances. So by no means economics is an exact science. You have to try to be as accurate and as precise as possible. And I am the last man on earth which can argue about something, because I need to learn. Still, I have to learn a lot more. But what I'm saying is that, for example, the Loebach-Williams model to achieve a neutral level of interest rate is more or less similar to the mechanics of the Taylor rule. But on the contrary, my focal point is that the overall economic system that we have today, it doesn't work on one level of interest rate, but for example, we should have a set of parameters, a level of interest rate which is for the real economy, and another benchmark of interest rate which is for financial asset and financial speculation. Of course, this thing is much easier to say than done, because the first objection that I can do to myself is, oh, there is an arbitrage, because if I want to set the level of interest rate, the optimal level of interest rate for the economy at 3.5%, and I want to set the optimal level of interest rate for the financial market at 4.5% or 4.6%, then there is a 100 basis points arbitrage that could be exploited, or that can generate some sort of disequilibrium. But of course, this is something that I will work out myself if I can, but it's not one of my first priorities. So, what is my idea? My idea is that the Taylor rule needs some improvements, which I don't think I'm the person that I'm bringing this improvement, but I will show you what is my theoretical framework of work. Okay, so I built a Taylor rule which is based on the I don't know if I can. No, I cannot write the Taylor rule. Okay, so basically we have a level of interest rate which is I or R, and then okay, just bear with me, chums, 1 second. I will do a little I'll try to take an empty page. Do I have an empty page somewhere? Okay, yeah, I have it here. So the Taylor rule says, okay, I want to know what is the level of interest rate, and the formula is the optimal level of interest rate is the actual level plus the of interest rate plus the actual level of inflation plus a parameter alpha, which normally is a fixed number, which is 0.5 or 1/2 otherwise, and the inflation gap, which is the no, sorry, let me it's just a formality, but this is the let's follow the formality. Okay, this is the level of inflation at time t, the level of inflation at time t, like today, minus the target of inflation, let's say 2%, although I don't believe it's 2%, minus beta, which is the same of alpha, and then it's the level of GDP at time t minus potential output. This is the Taylor rule. Now, my first belief was, okay, to this Taylor rule I want to add a sigma. Sigma in this case is volatility, and I want to add a conditional volatility parameter times a gamma, a coefficient, at time t of inflation. Okay, because it's not sufficient for me to know what is the inflation gap. So what is the inflation today vis-a-vis my the inflation target, which is 2%. And about the inflation target, we could go on and on and on and on, because inflation, they want it symmetric to 2%. Okay, let's say this, they have a normal distribution, but it's symmetric around 2%. So the average, the mean, has to be 2%. But there is a problem. Although this, you can theoretically argue that inflation is normally distributed, although I have some doubts that it's normally distributed. In fact, if you do the stationarity analysis of the inflation historical time series, you will see that inflation is not normally distributed. So if inflation is not normally distributed, and it has another feature, which is heteroscedastic, so it means that the error variance, like there is, when I do the first difference, I have also a term which is the error term. So the sigma of ET, it's not constant, it's not equal to K, so it's not, even the variance of the error in inflation is not a constant term. So that means that in itself all the historical data and the behavior of inflation across time, it's volatile, and its volatility is not constant, but also volatility varies. And I want to give you a very easy example. If today you go to the petrol station and you find petrol that costs, I don't know, £1.60 per liter or $3 per gallon, you basically spend, I don't know, $20 or £20 to fill up the tank, and you will do 50 kilometers, okay, or 50 miles, right? So tomorrow you go to the same petrol station and you will find that gasoline is not $3 a gallon, as I said 1 minute before, or it's not £1.60 a liter, but it's $3 and $3.50 a gallon, or it's £2 a liter. So with the same $20 or £20, you will try to fill up the tank. The result is that you will have less fuel in your tank, in your car or your motorbike, and you will not cover 50 miles, but you will cover 40 miles. This is the same of inflation. So the variability of inflation, so the volatility of inflation, it's not constant, it varies. And so you have different results with the same parameter. Okay, I can cover different mileage, more or less mileage, according to how the gasoline price changes with the same input, which is $20 or 20 pounds. So with the same input, by measuring inflation according to how is volatile the price, how vary the price, then I will have different outputs, which is inflation going up or down. And logically, this means that inflation is not homoscedastic. The distribution of the historical data of inflation is not normal, it's not symmetric to 2%, it is not symmetric to 0, it's not normally distributed, and the volatility of inflation is not constant, it's heteroscedastic. The volatility varies across time. So you can use standard deviation, rolling 7-21 days standard deviation, or historical volatility to measure the volatility of inflation. You will find that it's not a constant, but it varies. You have so many different values. Okay, so that's why the theoretical framework on which is based monetary policy, it seems to me that it's totally flawed, because you presume that you have a fixed parameter which is 2% inflation, but by no means inflation in itself is a constant. It varies. Volatility of inflation also is heteroscedastic, so it varies. The error variance of inflation is heteroscedastic, unless you use robust standard error, and then basically you nullify all variance effect or error variance effect, but at that point you cannot measure anything. So from having all of this concept that I'm just telling you, inflation is volatile, we all see that prices change all the time, retail prices change all the time, and all the time prices go up and up and up. And maybe the petrol station gasoline is $3, maybe in another state it's $2.80, or in another state it's $4. So I mean, an ordinary person can understand that inflation, the volatility of inflation or the variance of prices is not constant. It varies like from a town to another. So it's very bewildering to assume that inflation, to work with a theoretical framework which you want to achieve an output which is symmetric to 2%, while your target in itself is not symmetric, it's asymmetric, it's volatile, and it's heteroscedastic. So the least I could do myself is to basically as I said in the beginning, I thought, okay, I want to add plus a sigma parameter, which is the conditional volatility of inflation. Okay, and you can use historical vol. I personally use a raft of GARCH models. So I use GARCH, EGARCH, TGARCH, EPARCH. I will have to refine my thinking, but at least I've confronted 4 GARCH models to have the conditional volatility of inflation. But then I said, okay, I want to make things simpler. And I say, okay, let's improve the formality of the Taylor rule by having the conditional volatility of real GDP here, and here the conditional volatility of inflation at time t. So you can take an average of conditional volatility, or what is the most recent parameter that you can find, and then by just only utilizing what is the Taylor rule, then I could achieve some sort of reasonable result. That I will show you now, but I can show you now, like nominal interest rate 3.57%. That would be the Fed fund rate. I will tell you what are the parameters that I put in and how I derived. The Taylor rule is not like solving an impossible integral or an SD, a stochastic differential equation, not even quantum mechanics. It's a very simple equation. It's based on addition, and it's nothing. It's a very simple equation. But it depends how you set your parameter. What do you inject into the equation that it can give you anything. Okay, so as I said, my first idea was to add a conditional volatility of inflation. Then, because I was not sure of what I was doing, I said, okay, I don't want to change the theoretical framework. I want to work around the formality of the formula and utilize some other parameters. Nevertheless, I will continue to explore what are the results with this variation in formulas by adding the conditional volatility instead of multiplying by the because you can do another very fancy stuff, and you can basically calculate you can use the central limit theorem to calculate the because I can take the inflation gap, I can turn it to the central limit theorem. I can say, okay, I can take x sorry about that, I will try to explain myself now. I can take pi bar, which is the average inflation of, I don't know, of the sample population of the past 20 years, minus pi the target, which is pi mu, right? Or mu pi or something like that. Let's make it mu pi, I believe. Mu pi. I'm sorry, I'm writing with the mouse, not with the. And then I standardize by the square root of sigma over n, the sample population, and I can standardize the inflation gap, and I can find the probability by which the inflation gap can be a positive gap or a negative gap, or what is the probability of the inflation gap, the probability distribution of the inflation gap that I have in this moment. So I can turn around stuff. When I saw the Taylor formula, I start to turn around things, and because you can change this formula and say, okay, I have pi bar minus mu pi square root of n equals sigma times the z score. Okay, so but this basically changed from a simple mathematical equation to a statistical terms, but this is all stuff that I will work around myself to have fun. Basically, this is what I do in my spare time, playing around things. But anyway, so back to me now. Back to the Taylor rule. Back to Taylor. What have you done today to make you feel proud? What have you done, Taylor, to make you feel proud? That's what you do. That's the way you do it. Okay. So remember this formula. Okay. So we use the. Okay, I will show you the code now. We go back to the code. And so what did I took? I took the as neutral level of interest rate. I took the average of the 1 year real rate. Okay, so you take the 1 year treasury real yield. I took the average of the historical time series, and I have this 0.76%. Then in this instance, I've used 2.38%, which is the most recent data of core inflation. I set my pi target, my neutral level target inflation 2%. The past quarter real GDP was 2%, and I have used the code with the Aldrich-Prescott filter to calculate the potential output, potential real GDP. You can see here the forecast, it's more or less around 2.5%. And I had another iteration before. My method is very, because potential output is in the Lobach-William, it's calculated in a completely different manner, and also many other economists which are a million times more important and much better than me, they have. So well, these are the data for the year 2000, and this is the code gives me another output. So you see the green line is the Aldrich-Prescott filter, and it already tells me that in 2024 going into 2025 we have a somewhat of tiny negative output, which can be reflected here as well. So I could basically, we see here forecast potential, it's 2.5. The historical, so the Aldrich-Prescott filter, it calculates, sorry about that, it calculates, extrapolates from the historical real GDP time series, the historical potential real GDP, the trend. And so the green line is based on historical data. The gold dashed line is based on the forecast that is derived from, calculated with the Aldrich, the HP filter. So theoretically I could use the 3% and see what is a negative output. So you can do all the stuff. So that's how I calculated the potential output. I just use an HP filter, Aldrich-Prescott filter, to real GDP. So I didn't do any particular stuff. And what I implemented was a first 4 models of this is real PCE, real personal consumption expenditure. So GARCH 1.1, EGARCH 1.1, TGARCH 1.1, EGARCH 1.1, and so I have the historical conditional volatility table. So I can see the most recent, the January conditional volatility of personal consumption expenditure, and then I have to double check with the p-values and the parameters of the models, the EGARCH models, what are the resulting parameters. And then I used this CPI, which is core CPI, and I repeated the same, GARCH, EGARCH, GARCH 1.1, EGARCH, TGARCH, EGARCH, they are all 1.1. Okay, so this is also another nuances, and then I have to double check what are the p-values, what is statistically significant, and I used TGARCH. I can say that the most reliable are EGARCH and TGARCH. Well, GARCH 1.1, EGARCH and TGARCH, but the most reliable parameters to me are EGARCH and TGARCH. EGARCH is not a good model, so I will not use it. So, going back to Taylor, we have past quarter real GDP 2.5%, potential GDP 2.5%, then the TGARCH, the latest conditional volatility parameter is this one. You see it? January, no, fourth quarter 2024, TGARCH 1.12, conditional vol, and the most recent parameter of GDP vol is 0.687, 0.68 or something. And so you see the result here. The nominal interest rate Taylor rule is 3.57%, and this is based on the average 1 year real yield. Why I took the 1 year? Because in as I said in my previous videos, in many monetary policy books, it's explained that the most accurate measure of what is the monetary policy is the 1 year yield. So we know that monetary policy sets the level of interest rate for short-term papers. It can be 30 days, 60 days, 90 days, short-term bonds, short-term notes. So it's the 1 month, 3 months, 6 months short-term T-notes, or I don't know, the 1 month, 3 months, 6 months Euribor for the euro area. And those level of interest rates, they are all linked to the interest rate tool of the central bank. So according to what is the level of interest rates that sets the central bank, like the SOFR for the Federal Reserve, the 1 month, 3 months, 6 months, they basically mirror the level of interest rate of the central bank, unless there are some other exogenous factors or risks in that I cannot cover now. But according to monetary policy books, what is the most approximate, most precise measure of what is the monetary policy cycle to project also the effect of monetary policy on aggregate output and on inflation, if there is an output cap, the yield, the duration to use, it's the 1 year yield. The benchmark is the 1 year yield. So with the 1 year yield, the Taylor rule using these parameters is 3.57%, and we know that yesterday the Federal Reserve just stood at 4.33%. They didn't cut interest rate. However, I have another nuance. Okay, I will show you now. So if I were a train, I'll be late. Okay, I will show you another table. Bear with me, champs, bear with me. This is wunderbar. This is tremendous. So you cannot see a real interest rate, 1 year, 10 year, 1 month. Okay, these are all the time series, and I took the average. Okay, I took the average of this. So the average real yield for the 10 years is 1.78. So if now for the neutral level of interest rate, I put 1.78, I have to run the code again. Fingers crossed, champs. Fingers crossed. Yeah, we got the result here. 4.59. Okay, which is very, very close to to the Federal Reserve, which is 4.33. So according to what is the duration, what is the benchmark that we use, that I am using for the neutral level of interest rate, not the neutral level, yeah, the parameter for interest rate, which I use, which parameters I prefer, is the 1 year real yield, average, or the 10 year real interest rate. I take the average and I find a parameter. It depends. If you take the average from 1950, it's a number. If you take the average from 1990 or from the year 2000, it's another number. So it's a whole raft of things. That's why. But just on a broader measure, if I input the average 10-year real interest rate, which is 1.78%, then the Taylor rule equilibria is 4.6%. So the Federal Reserve should hike by 25 basis points, arguing that the inflation output, arguing this, that the inflation output and the real GDP output, the inflation gap, mind the gap, mind the gap. So YT gap and pi gap, they are multiplied by a parameter which is the conditional volatility of inflation and the conditional volatility of real GDP. Now, something that I'm not aware of. Okay, basically the original alpha and beta parameter that are in the Taylor rule, normally the economists at the central bank, they already use the standard deviation of volatility. Fine, no problem. I'm just showing you my work. I don't mind. So for all of you that are watching this video, I hope you are interested. I hope you like the video. Just subscribe. Please follow me, no problems. Okay. Now, we can just try to play around things. Okay. Let's say we take the historical trend and we want to say that there is a negative output gap. Oh, so we have a parameter which is totally bonkers. So we cannot have a negative output gap. So that's why the formula needs to be refined. Okay, we can try and use the EGARCH model. Okay, so if I take the EGARCH conditional volatility of core inflation, which is EGARCH 1.015. Okay, so let's change this to 1.015. Then I have to go back up and find the GDP, real GDP GARCH models, which they will be somewhere. Bear with me, chums. I think we got it. We got it. Conditional volatility, real GDP, potential output, new, yes, no, but no, yeah, but no, yes, but no, but yeah, but no. Real GDP, yeah. Oh my god, I'm sorry, I haven't prepared all of these things. Bear with me, chums. Bear with me. We will find real GDP somewhere. PCI. Oh, come on. Where is this real GDP? Where is the real GDP? Where is the real GDP? Where is the real GDP? Parameters. Okay. GDP. Okay, conditional law. PCE. I'm bewildered. I should have made sure that I had the data pronto. Presto, pronto, like voila. And this is the omega, the beta, no, because it works in another way. EGARCH parameters. Oh my good lord. Okay. This is EGARCH. GDP, oh, okay, oh, hallelujah, 0.545. Okay. Hallelujah. Chums, are you okay? So, a lower conditional volatility, let's run the code. More or less the same. Is that possible? I don't believe so. Yeah, more or less the same. Let's use... That's why I have to refine my code. Okay, got the same result, even if I'm changing the volatility around. No, but I haven't changed the TGARCH. No, 1 second, chumps. 1 second, 1.01. I haven't changed this parameter. Because basically, if the output gap is 0, so this volatility parameters, it doesn't do any good. Yeah, okay, so still it's 3.5% with the 1 year real yield average, and it will be 4.5% with the 10-year, yeah. even if I change the conditional volatility parameter. Now, if I have a positive output gap, let's see what is the result if the machine is able. 18%. So the model needs to be calibrated somewhat, because oh yeah, this is huge. Is that real? Is that even possible? 17%. That's why it's so the output gap has to be 0 for this thing to work, because otherwise it won't work. Anytime I have a let's see, 2.6, 2.7, it's huge, it's really huge. If I have a negative output gap of just minus 0.2, then the TGARCH parameter is 0.5, which is very similar to the basic Taylor rule parameter. Then it would be 0.5%. So that's why I'm not really convinced about what is this formula that the economist Taylor put in place. But anyway, nevertheless, if we change around the, now I won't hold you longer, but basically if we change around the inflation parameter from core inflation to core PCE, core personal consumption expenditure, then the level of interest rate, it should be much higher, because core PCE, the latest data, it's a very hot core PCE. Yeah, I have it here. Sorry, I'm checking the, okay. So the latest core PCE, it's 3.15%. Okay, let's write it here. 3.15. Let's use the average 1 year real yield parameter. Let's assume a 0 output gap. Inflation target is 2, and I have to now go and double check what are the GARCH parameters for the core PCE. This is PCE inflation or core PCE. Okay, this is core PCE. I have the table here. We are lucky, chumps. And you can see the EGARCH parameter is 2.62. Oh, let's use the TGARCH parameter. Also because this EGARCH p-values are not good. The TGARCH model, extrapolating the historical conditional volatility, I have these two p-values which are not so great, but the gamma and beta are statistically significant. Same is for the EGARCH, the omega parameter. So the EGARCH model probably fits better. Statistically, it's more relevant. It fits better than the TGARCH parameter, the model. And the GARCH 1 model also, but we see that the omega parameter here, the p-value is much lower than here, so the optimal model would be the EGARCH model. If I take the conditional volatility of core PCE is 2.62. Let's see what happens to this puppet. 2.62. Let's bear in mind it's core PCE. Bang! 6.9%, 7%. So, if the last quarter Q4 2024 core PCE it's 3.15%, and basically if the Fed wants 2% real yield in money market, the Fed funds should be discounted just for the plain core PCE. It should be 5.15%. Yeah, 3% is inflation, 5% should be the Fed funds to have a 2% real yield on top of what is core PCE. Okay, but if I inject the conditional volatility parameter of core PCE, I have 6.9 percent or even 7% Fed fund rate. Okay, so injecting as a parameter into the equation the conditional volatility of inflation, then the level of interest rate would be, it needs to be much higher. Okay, so in this case, if I set the level, the Fed fund rate at 6.75 to 7%, let's do a simple thing. If I set the level of interest rate as 6.75, if I follow this equation, the result of this equation, minus core PCE, I'll have 3.6% real yield on money market, on money, like your check and your deposit account, yeah, that would yield 3.6% on any penny or dollar which would be deposited. Okay, but now the Federal Reserve is at 4.33 minus 3.15, which is core PCE, so the real yield is a little bit more than 1%, right? And this level of interest rate will be for savers. Now, if I want to set the level of interest rate for financial market, I would use the average 10-year real yield, because the 10-year treasury is the collateral, is the debt security collateral par excellence for hedge funds, pension funds. The repo market is the plumbing of the financial markets, the financial system, the 10-year treasury, or the treasury market on a broader scale. So if I want to set another level of interest rate which is only for financial investments, I'll run the code and I have 7.94. So I will have a Fed fund. So what if I were, if tomorrow I become the chairman or I work at the FOMC committee, so I work for the Federal Reserve and I get to decide what are the level of interest rate, I would say basically we start to have two levels of interest rate. One is for savers and borrowers in the real economy, and one is for savers but mostly borrowers and repo facilities in financial markets. What I will do, I will take the average of the 10-year treasury real interest rate, and I will take a parameter, will work out a parameter, and then basically I will take the core PCE, core personal consumption expenditure, because GDP in the United States is measured by consumption, not only by the level of inflation, although you can use core inflation, sticky prices, I don't know, whatever you like. So let's take core PCE. I set a target of 2%, and I will have to work out better what is the output gap, and then I will take the EGARCH conditional volatility parameter of core PCE and the EGARCH conditional volatility, or TGARCH conditional volatility parameter of real GDP. I will have my nice equation, and with the 10-year, the average 10-year yield, I will set the level of interest rate for financial asset for the financial system to 8%. And for American savers and borrowers, I will set the level of interest rate to 6.75% to 7%. Okay? Otherwise, I can choose to use the what is the core inflation measure. Let me go back on, because I have this data, all this Excel, and I have to find the CPI somewhere. CPI. So this is core PCE. Let's see if it's here. Yeah, I think it's here probably somewhere. I hope so. PCE. Okay, this is core inflation. Okay, so core inflation, the average core inflation in the past from 1998 to 2024 is 2.38%. Okay, so instead of using core PCE, I use core inflation 2.38. Let's work out 4%. But then I'll have to change this one to 1.15. It's 3.5%. Okay, because the conditional volatility parameter is not core PCE, but it's core inflation. Okay, so what to do? Personally, I would use the core PCE, okay, and I will take the to have a more restrictive level of interest rate, and I will use the EGARCH parameter 2.62. Okay, then I will simulate also with the TGARCH parameter, which is 0.58. So this is 2.62. Let's run the code again, and 6.9. But if I take 6.75 to 7% for the real economy and 8% for financial markets, so I will have two sets of interest rate, two sets of Fed funds. One is the SOFR, and another one is the SOFR for financial markets. Okay, and just making it very, very simpler, because then there are already many other level of borrowing rates, which is the repo rate, and then the SOFR has an upper limit and a lower limit. But just to give you a broader idea, what I will do, I will have two levels of interest rate. One based on the 10-year average real interest rate, which is 1.78%, and this benchmark would be only for investment banks, hedge funds, etc., 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 and the like in the stock market. And another level of interest rate, which is for the real economy. If the average grocery store wants to borrow, that would be the average level of interest rate. And that's my that's all, folks. That's my theoretical model of Taylor rule. So Taylor rule again, just to wrap up, the neutral level of interest rate, which can be the 10-year average real yield for banks, for financial institution, or the 1-year real yield for the SOFR rate, which is for ordinary borrowers in the economy. Sorry about that. And then I would use the conditional volatility of core PCE, core personal consumption expenditure, mind the gap, the inflation gap of core PCE plus the conditional volatility of real GDP and the output gap of real GDP. That's how I do it, just for academic work, for study. If you have any suggestion, if you want to teach me everything about the Taylor rule, please do so, because I always need to learn. And I hope I will be back soon with more material. I could continue now the video for a lot longer, because I have a lot of simulation about what can be the theoretical impact of tariffs. I will show you now only the ARIMA and SARIMA models for certain import prices index. Bear with me, chums, 1 second. And oh, that's the OLS. Okay, I think we got here. Yeah, okay, so we asked the machine. I have a CSV file with where I took import prices of cars, import prices of car parts, import prices of all commodities, and fit a seasonal ARIMA and SARIMA model optimized with the first difference up to 5, and add on top a dummy variable. There must be a dummy variable somewhere. Loop through, create forecast, set frequency. Okay, add, you see here, add dummy variable, tariffs. So there should be a dummy variable worked out, but nevertheless, because I specified 25% tariff dummy variable, there should be 25%. Yeah, start from January 2025. Yeah, 25% imports. Okay, so this, the Python code should work more or less properly. So the SARIMA with tariffs. So this one, just bear with me, chums. I will tell you. So this one is the consumer price index of used car and trucks on average for all US cities. And this specific measure of CPI of used car and trucks, theoretically, just for the iteration of these historical data, with an additional dummy variable of 25% import tariffs, it shows a line going up to 10%. And well, this is the same of 8-quarter forecast. So you have what the autoregressive integrated moving average model tells me is that there should be an initial shock, inflationary shock, applied, for example, on used cars and trucks. The same is for this one. This PCU, it's producer price index of new car dealers. So the producer price index of new car dealers also could see an inflationary shock of well above 10%, 15%, and the 8-quarter forecast shows the subsequent decline. But in the first 4 quarters, just starting from Q1 2025, if I apply tariff starts January 2025, a dummy variable of fixed 25% tariff, then the output of the machine is an inflationary shock, theoretical inflationary shock. This time series is consumer CPI for all urban consumer, for new and used motor vehicles for US city average, and there is a bump, another inflationary shock going up to 2.5%. And yeah, this is the same. Producer price index, consumer price index of new and used vehicles, US city average. This one, it seems to me Carabao Cup. It's not a Carabao Cup. It's not Carvana. What is it? It's consumer loans. So other consumer loans, automobile loans, or commercial banks, billions of dollars, seasonally adjusted. This would be the percentage change year on year, and the machine shows a theoretical uptick in consumer loans. This is total sales. Total sales will be basically sort of flatlining in 4 and 8 quarters, even negative, maybe negative impact at the beginning. This is clearly automotive or something like that. So this acronym is manufacturers' new orders of motor vehicles and parts. So new orders of motor vehicles and parts. It should be, that's the forecast. It seems pretty flat to zero, but we will see the table just in a bit. These are trucks, as I can see here. Where is it? H trucks, I don't know. Yeah, this must be something related to trucks. I'm sorry. Bear with me, chums. Bear with me. Import prices. Okay. So bear with me. But anyway, nevertheless, the initial impact should be negative, and then in a positive percentage change year on year of tariffs. Okay, I will tell you in a second, because I'm searching the acronym exactly what it is. Track AAR, no options. Track. Oh, okay. So these are okay. So these are motor vehicle sales of what? Heavy trucks. Okay, so the motor vehicle sales of heavy trucks. It seems to me that it has a negative impact and then bounces up, like normalizing, absorbing the shock. Okay, I should be able to see the so these are import prices, and nevertheless it should be like impacting more or less import prices. These are import prices of import prices So IR, it's import prices for all commodities, and it should be more or less in line with the trend, but still positive import prices. These are import prices just of automotive vehicles and parts, and the forecast starts from 1, so like a negative shock, I don't know why, and then it adjusts a little bit upward. This is the 8 quarters forecast, so there is some random shock for import prices of, and these are sticky prices excluding energy, food and shelter, and we don't have a particular shock here, inflationary shock on derived from tariffs. And this one, it's auto, so it's retail sales of autos, of vehicles, cars, whether it's domestic cars or imported cars, and it seems that it's declining. It doesn't show me a particular shock that derives from a dummy variable, which is tariffs. And this M are something, it's retail sales for automobile dealers. So there seems to me a sort of initial shock, because the line starts from 0 and then bounces up again. So the dummy variable is an initial shock immediately when the tariffs come in place, like for all the car dealers and the import prices. Some are very large shock. Also the prices of used cars or trucks or new cars, maybe there could be an inflationary shock on that front. These are really interesting because it's expanded for all the, and okay, so you can see just the numbers. Okay, so the numbers are very interesting. So this one, again, it's the consumer price, or all consumers on average US cities of used car and trucks, and the dummy variable brings out some very large inflationary shock: 4%, 8.3%, 10.7%, 4.3%, like the persistency of the inflationary shock. This one, it starts very little, but then it grows exponentially, and it's the producer price index of new car dealers. So the inflationary shock of tariffs to new car dealers, it could be as high as 10 to 16%, which seems to me, I don't know, reasonable, unreasonable, I don't know what it seems to me, but that's what the machine does. This is the CPI, new and used motor vehicles, and you have an initial negative shock and then some sort of average cost, very contained. Carabao Cup. Oh, okay. These are that's the issuance of consumer loans, which would be negative in the first quarter, but then you have, let's say that the machine derives that the shock is absorbed, and you have issuance of car loans by 1.3, 1.8, 1.9% quarter on quarter. So, assuming that tariffs go in place in 1st of January, for total sales, you can see here you have an initial shock of minus 4.75%, but because tariffs like cars and parts that go in and out of Mexico or Canada or from wherever come from Europe or Japan, tariffs, they go in place in Q2, in the second quarter, so this shock would materialize, I think, in Q2, Q3, and here I have the fall in total sales is minus 4.7, then normalizing to 2, then you flat like 1%, and then after 3 quarters it balances out the initial shock. Yeah, this is that's automobile sales or something very similar. Total sales, oh, that's manufacturer new orders. So if the tariff shock is in Q1, you have an initial shock of minus 4%, so new orders of new dealer or car dealers could contract by 4% as a consequence of an initial shock of import tariff, for example, on cars, and then the shock normalizes and is absorbed. Then heavy truck, they have 2 quarters of shock, minus 7.2 and minus 5%, and then it does normalize because these positive percentages, they don't absorb the whole shock. And these are import prices, so all commodity import prices. This that's import prices for automotives, new autos and cars. So marginal inflationary shock on import prices. This is sticky prices, and there is no shock to see here. Then that's autos, something related to motor vehicle sales. Yeah, so that's retail sales of cars produced in the United States or car imported from outside the United States, and you have retail sales could decline by 3 quarters in a row. So if I have 25% import tariffs as a dummy variable, as a fixed dummy variable, and iterates through the ARIMA and the SARIMA model, even if you use it on an OLS regression, then the outcome, the dependent variable, which is retail sales of cars, it shows that it has negative shock, minus 7% on the first quarter. Thereafter, tariffs kick in, minus 1.9%. You can see the parameters here, minus 5.5%. So retail sales of cars should theoretically could collapse in the following 3 quarters, and then you have a marginal absorption of these things, which is 0. Something. What's this? What's this? Okay, retail sales in $1 million, not seasonally adjusted, so this would be positive, but it's measured by millions of dollars, so it's somewhat contradictory of this one. But let me clear up. Okay, so that's a time series that measures the millions of units. So what happens is exactly what a 25% import tariff consequences are, that the number of cars, of units of cars sold would collapse by 7%, 1.9%, and 5.5%. But the millions, the retail sales measured according to the monetary quantities in millions of dollars, then you have an inflationary effect of 7%, 5%, and 7% again. Sort of inflationary effect. So the amount paid would bump up, of course, with the tariff, 25% tariff, but the aggregate amount, number of units of cars sold will be less, will be negative, although it's totally an inflationary effect, because the monetary amount money would inflate just because only of the 25% tariffs, and these are real interest rate, and we are not interested in this. And there are also the 8th quarter forecasts, but I mean, my aim is to see that on the 8th quarter forecast you have huge inflationary spiral of these things. So only by doing an autoregressive integrated moving average work and applying a dummy variable to the regression, the machine works out inflationary shock on import prices, on consumer prices for new car, used cars, for trucks, for heavy trucks, and import prices. They have some sort of inflationary shock. What also derives is that you'll have a decline of sales, total sales of number of units here. This is the LA auto, so it's the number of units of cars could decline by 3 quarters in a row. Total sales also will decline. And let me just, sorry, I want to, so heavy truck sales, automotive sales, or total sales, you all see here heavy trucks can decline by 2 quarters in a row. Automotive sales, they have an immediate impact of -4, -5%. And what happens is that the number of units of cars measured by retail sales in the economy, whether it's domestic cars, or car produced in the United States, or cars that come into the United States, or parts of vehicles that come into the United States, nevertheless, the whole amount of units will decline, can theoretically decline by -7%, -1.9%, -5.5%. But at the end of the fairy tale, of the tale at the end of the fair, at the end of all the circus, the amount paid would still grow by 7%, 5.75 and 7%. That's the work the machine does, and thank you very much all for listening to me. I hope you enjoyed this content. Please watch my video, and I will be back soon with these two works that I have here on imports prices, tariffs, and econometric forecast and projection of all the macroeconomic variables for the United States economy. Thanks a lot to all. A big hug from me. Cheers.